This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Hey, good morning. Welcome to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning, and you're listening to Dollars and Cents, Central Florida's longest-running radio program. Started over 30 years ago by my late father-in-law, Jack Nelson. Continued today by me, yours truly, Joel Garris. On the program, we talk about anything and everything that has anything to do with your dollars, helping you make sense out of all of those different decisions that go in to pretty much a wide array of things in life, whether it be retiring or investments or maybe taxes. Wow. Yeah. Tomorrow's the deadline. We're going to talk about on the program what you need to do if you don't think that you're going to be able to get them done. There are some things that you need to, at the very minimum, do. Otherwise, you may find that you regret it. So we'll talk about the looming tax deadline tomorrow and what to do to prepare for it if you have not filed your taxes. Hopefully, however, you've filed your taxes and that is all behind you, but perhaps it's not. So we'll talk about what you need to do now in order to make sure that you are good with the IRS, if you will. Also on the program, we will talk about how to get a mortgage, or whether you can, in the first place, get a mortgage in retirement. I had a client share with us this past week that she was thinking of downsizing and going to be selling her house and getting something maybe a little bit smaller, but wanted to finance some portion on that next house. And lo and behold, her real estate agent was telling her, oh, well, you might have a problem in retirement getting a mortgage. We'll talk about that. Is that really a concern to have? So we will cover that topic as well. And then talk a little bit about the exercise of figuring your basis and what that means as it relates to an investment. We'll also be talking about step-up concepts that help folks when somebody passes away to avoid all of those gains, but if you wind up making a gift of that appreciation, then you don't avoid those gains on assets. So a host of stuff to talk about, obviously with a little bit of a tax flavor, if you will, on the program today. So let's begin. So tomorrow is April 15, and that means that your taxes are due. Now, in contrast to prior years, it seems like pretty much every year for the past 3 or 4 years, there's always been something that has pushed it a day or two the other way. So oftentimes it's kind of obscure holidays in the District of Columbia, or for a couple of years there, as the calendar falls, the 15th fell on a Saturday or a Sunday. So that moved the date to maybe the 16th or the 17th. And it seemed like there for 3 or 4 years it wasn't April 15th. It was always like 1 or 2 days after. Well, let me be very clear. It is April 15th this year. That is the date to file it. I think there's some exception in Maine and Massachusetts, but hey, we're not in Maine and Massachusetts. We're in Florida. So April 15th is the date. So let's say that it is what it is, and you're sitting there, and it's the day before tax filing, and you just don't have it done. Okay, you just, whatever reason, wasn't able to get it organized, get it together, get all the right documents. Maybe someone didn't mail you the right documents, or maybe you're still waiting. That just happens to be how it played out. So you're not in the position to be able to file. What should you do? Well, first of all, okay, make sure that you file an extension. At least check in with the folks at the IRS and say, hey, okay, not able to get it done, so I'll take my extension. First part of the extension would run till August, and then it's automatic that it gets extended to October. So you've got some extra time to be able to submit your return and still have it be properly filed. But, and here's the big but, you really need to at least take a look at the numbers and try and run a scenario under the new tax law, because in order to find out whether you're going to owe or get a refund. And I understand that that's not going to be an exact exercise. So when you run the analysis, keep it as conservative as it can be. One of the things that we've been commenting over the course of the past 3 months on this program is that the tax changes that happen really are producing a little bit of a hit or miss in terms of whether you're going to get more money or, in fact, have to pay more money in. And that's simply because a lot of the deductions that you had before are gone. If you were on a standard deduction, you're still probably going to be on a standard deduction because the standard deduction went up. But if you're itemizing, that's the group of people that are seeing their taxes actually go up a little bit because they're losing the ability to take the combination of itemized deductions and personal exemptions. Because with the increase to the higher standard deduction, the personal exemption deduction, which was $4,000 per person, goes away. So ultimately, the higher standard deduction simply replaces what was previously a combined deduction of a standard deduction and a personal exemption that for a married couple was around $20,000. That got replaced with a new standard deduction of $24,000. But if you were itemizing, let's say you were itemizing and had $16,000, $17,000, $18,000 of itemized expenses and a personal exemption that was another $8,000, well, you actually had $26,000 of deductions or write-offs. Now you only have $24,000. So you see how that can sort of cut against you. But bottom line, for purposes of tomorrow, and you're not going to be able to get your return done, you really need to kind of run that analysis and see whether you owe or not. Because if you do owe and don't pay in something towards that, then that's when the penalties and interest can get very, very high very, very quickly. So by the time you actually turn around to file the return for real in October, you're going to owe an awful lot more than what you expect. So you've really got to take the time to do that projection and just see where you are at. And if you looks like you owe, you better throw a deposit in with your extension tomorrow. Otherwise, you're going to get hit with a much, much bigger surprise. So those are some things to think about as we look ahead to tomorrow and the tax filing deadline. When we get back, we will continue the conversation. We'll talk a little bit about getting a mortgage in retirement, whether you can or whether you can't. A bit of a debate out there based upon a conversation I had with a client this past week. So we thought we would share that debate with you on the program. We'll do that next up here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents on News Radio 93.1 WFLA. In the first part of the program, we talked a little bit about the fact that tomorrow is April 15, and if you don't have your taxes together, what can you do? Well, first and foremost, you should certainly file an extension, but there's a second part of that. You really need to sort of at least do as close of a projection as you can to determine whether, in fact, you will owe money, because if you do, then you probably don't want to wait until October when it's the final deadline to pay that money, because if you do, then not only will you pay that, but you will pay a very high amount of interest and penalties. So to avoid that, then you at least have got to take a crack at, okay, here's what my tax liability might be, and then at least make that deposit for that amount when you file the extension. And then that way you can avoid penalties and interest that would accrue at a pretty good clip if you wait and pay when you actually submit the return down the road. So some important stuff to be thinking about if it looks like you're not going to be able to get it all done before the finish line. Particularly this year, it's important to run that analysis more than probably any other year because of how significant the tax changes were. And how their impact is affecting different people. Do you itemize or do you not? There's potentially a greater impact if you itemized before, but now you may not be. But that may very well mean that you wind up with less total deductions, because the higher standard deduction this year simply eliminated the personal exemption as well. So that's a significant change that we don't often hear many people talk about, but it is certainly significant for those that itemized in the past, combined with the fact that the other part of the issue is, yes, there are lower tax rates, and that's fantastic, but, and it's a big but, your withholding on your paycheck already changed to reflect that at the beginning of last year. So many people are finding that their withholding is actually less than what it was the prior year through no fault of their own. They didn't change their withholding, but their withholding is less because these tax cuts got put into the withholding schedule. So their paychecks went up a little bit every pay period, but I guess it's one of those things where if your paycheck goes up $20 or $30 a week on an after-tax basis, or your take-home pay goes up $20 or $30 a week, maybe you see that, maybe you don't. But the reality is, if that occurs over the course of the year, that's $1,000. That's a big difference on your taxes. So make sure you take a look at that. And if you owe, or you believe you're going to owe, or it looks like you're going to owe, you better throw money in with that extension. Otherwise, you're going to get hit with interest and penalties. Speaking of penalties or those types of things, interesting conversation this past week with somebody who was looking at the sort of a normal situation, if you think about it, where we're looking to sell the big house, looking to maybe downsize into some kind of a townhouse, and ultimately make that sort of transition for the road ahead. And it seemed like, or at least this was the information that they got from their real estate agent, that, oh my goodness, I'm going to have a hard time getting a mortgage because I am retired, and sort of effectively being penalized for being retired, not being able to borrow money. And To which I responded, well, that's not accurate at all, because we see that we see clients that are retired and have some of them retired for many years, that have no issues with getting a mortgage. So don't quite believe that if somebody tells you that. If you're looking to downsize and change your living arrangements, it is still certainly possible to get a mortgage just because you are not working. And here's how to think about it. Okay, so in this particular case, she was looking at not an excessively large mortgage to take out. She was looking at basically a $200,000 mortgage. $200,000 mortgage would be about maybe a $1,200 or $1,300 per month payment. So that's less than what you might pay for renting many places in Central Florida these days. But at the end of the day, it was $1,200 or $1,300. And I said to her, well, wait a minute. You're collecting Social Security, and that's a couple of $1,000s a month. So right there, okay, you've got a couple of $1,000s a month that is certainly provable income. It shows up on your tax return, and even though you are retired, okay, well, you've got close to $600,000 in an IRA, and you could certainly, for the purposes of the bank's loan application, assume $3,000 a month off of that IRA, and there you go. You've got $5,000 a month of income, and you're looking at a $1,200 mortgage. That's less than a quarter of your total pay. That's certainly doable and should have no issues, assuming no other credit issues, and this person didn't, to get a mortgage without any trouble at all. So let me be clear on that. If you have heard differently, I would suggest to do some additional investigation. The suggestion that just because you are retired and can't borrow money or can't get a mortgage is false. Now, obviously, you have to meet the parameters. You have to have the credit score. But if you stop and think about, well, wait a minute, I'm retired, but I'm still collecting income. How am I doing that? And aren't I reporting and paying taxes on that? Well, of course you are. That income is made up of Social Security. It's made up of the pension that you get. It's made up of the retirement withdrawals that you get. All of that comes together to present an income picture that ultimately should satisfy the parameters for any mortgage. Now, obviously, it's got to be a mortgage within your means, but by no stretch of the imagination, just because you are retired, the suggestion that you can't get a mortgage is just silly, because you've got provable income just like anybody that was working. So, wanted to just chat briefly with you all on that one, because that one was one that we hadn't come across in a while. But we thought it was kind of interesting and worth sharing with you all on the program, because at the end of the day, maybe you did hear that. And in this case, this person heard it, was told it by their real estate agent, and was considering completely changing what they intended to do. Was going to take their current house back off the market and just say, well, forget it. I guess I'll stay with the large house with the big yard and the pool, and I don't want to deal with all that stuff, but if I have to, I will. Well, no, okay? You can certainly make that transition, and just because you're retired certainly doesn't mean that you can't get a mortgage. You've got provable income just like anybody else, between Social Security, retirement income, any pension income, any dividend income. All of that would certainly go towards proving income and be able to qualify for a mortgage. So if you're looking to downsize, if you're looking to kind of do things differently in retirement, don't get scared out of it because someone makes a silly statement like, oh, you're never going to get a mortgage because you're retired. Not true at all. And we see that all the time in the office. Now, in those situations, we sometimes have to write letters for our clients and say, okay, here's the income, or here's how much income that they could get out of their portfolio if they wanted to. And typically those letters have to have a sentence in there that says it's expected to last for at least 3 years. That's something that the lenders kind of all look for. But those are easy letters to produce. And at the end of the day, should certainly allow you to be able to get a loan, a mortgage, regardless of whether you are retired or not. So just some comments on that. When we get back, we'll continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. On the program, of course, it's the day before April 15th, so we've talked a little bit about what you should be doing if you are not ready for April 15th. You really need to project how much you think you owe and make sure you pay that in with your extension. Otherwise, you'll be subject to some interest and penalties come October. And then in the last segment, we were talking a little bit about, yes, in fact, Virginia, you can get a mortgage in retirement. It works the same way as it does if you were still working. The suggestion that you can't is simply silly. You've got provable income in retirement. Otherwise, you wouldn't have retired, or you shouldn't have retired if you didn't. You can use that income to easily demonstrate to the lender that, yes, I have income that's coming in, so I certainly qualify for the mortgage. Other tax topics of note is the notion of when you sell an asset, whether it's property or stocks or investments or mutual funds. It's very important that you figure out the basis appropriately. In today's world, that is often recorded and kept track of, but oftentimes it's that old stuff that you've had for a while where that information may not be readily available. So what is basis and why is it important as it relates to the sale of any investment? Well, basis simply is another word for your cost, how much money you put into it initially and, of course, along the way. So in the example of a piece of property, maybe that was the amount of money that you put in to upkeep it or to improve it. Those types of things would add to that initial price that you paid and thereby form your basis or cost for that particular investment. And that's important because, and the reason why you want to keep accurate numbers on that is that the higher the basis, the higher the cost, the lower the potential tax issues are. So when you sell an investment property or a stock or a fund that you've owned a long time, and let's say you sell it for $10,000 and the basis is $5,000, well, then you've got $5,000 to report as a capital gain on your Schedule D on your tax return. Well, if you kept better records and came up with $6,000 as a basis, then you would only have $4,000 to report as a capital gain on your tax return. And while that may not sound like much, okay, that's $150 more in your pocket just on that simple example of an extra $1,000 in basis on a $10,000 investment. So imagine if you put a couple of zeros on that, that can very quickly turn into real money. So it's so important to when you've got to do that calculation. Okay, maybe it's an old account that you've had for a while, or maybe it was a stock that you inherited, or maybe it was a property that you bought 20 years ago. Whatever the case may be, it's so important to kind of do that exercise to gather that information in order for you to present the most accurate and most efficient tax picture on your tax return. The basis concept or the cost concept is another concept that comes very much into play with respect to assets that folks have held for a while that have a high level of appreciation. And so if they were to sell those assets, then obviously they would have a gain. They'd have to recognize that and put that on your tax return. Well, here's the interesting wrinkle, if you will. If they pass away, then the cost basis, okay, in that investment actually shifts up to the value at date of death. Folks, I don't know why that's the rule. I just know that that's the rule. And basis, the cost that you have in to an investment moves up, whether it's a piece of real estate, a stock, a fund, whatever the case may be, the basis immediately moves up to the value at the date of death. So effectively, what happens there is that gain that would have been taxable had the previous owner sold it completely goes away, completely disappears. And now you have the option as the beneficiary to sell and not have to ever worry about anybody paying that capital gain. As you might well imagine, the folks in Washington on a regular basis circle back to this basis concept because, boy, they sure would like to figure out a way to get that profit taxable, because right now it is certainly not. Because if it's held until the owner passes, then the basis steps up equal to that value at death, thereby eliminating the gain. Now, here's where it doesn't work. Let's say you're alive and you give that investment or that stock or that fund over to somebody. Guess what? The step up in basis will not happen, will not follow, because you gave up ownership to that while you were still living. And what happens in that situation is that then the new account owner assumes the same basis as the original one. See, when you give a gift of investments or stocks or funds that have appreciated over time, then you wind up also giving your cost basis. There's no avoiding the tax on that gain like there would be if you passed. There's no avoiding that when you make a gift. So an important concept there on basis, and why it's important to try and figure it out, is because it really helps to reduce down your capital gains that would typically be applicable on the sale of an investment like that. So very important to keep good records. Very important to think about whether you want to make a gift now to somebody, or whether you wait and just let them have it when you pass. That's obviously the more tax-efficient way in which to do that, because then the value simply becomes, or the basis simply becomes equal to the value at the date of death. So some important concepts on basis, and ultimately how that works as well. If you are given the property, if you're given the property, then you have to take their original basis that the original account owner had. So oftentimes the better option is to sort of leave those highly appreciated assets alone, particularly if the person is older, and ultimately recognize that, hey, at passing, the value, the basis is going to step up equal to the value. So then there's no real tax consequence on the subsequent selling of those investments. So very important to kind of keep track of that basis number and be aware of how these concepts work together. If you're getting up there in age, it may be better to just have them inherit it rather than to give them it now. Because if you give them the property, or if you sell the property and give them the cash, well then now you're going to have to deal with the gain and report that on your taxes. So some important concepts on there in terms of basis and how it relates to different investments. We will slide to the break. When we get back from the break, it's our final segment of the morning, so stay tuned for that. This is Dollars and Cents, and my name is Joel Garris of Nelson Financial Planning, and you're listening to 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give them a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Today is April 14th, which means tomorrow is April 15th, so you better be filing your taxes, and if not, then as we mentioned earlier in the program, figure out whether you owe or not, and if you do owe, you're going to need to throw some money in with that extension. In terms of what you can do to still lower your tax liability for the year 2018, well, that sort of ends tomorrow, but I guess you've got a little bit of time left if you're still trying to figure out ways to lower your tax liability. There are still some options, predominantly in the form of IRAs and health savings accounts. So if you've got a high deductible health insurance plan that integrates with a health savings account, then you can certainly fund that health savings account for the prior year 2018. And get a tax deduction for that. Similarly, you could also do that with a traditional IRA. Now, be careful on that because you've got to make sure that, in fact, it is available to you, because your ability to deduct an IRA is a function of a few other parameters. Namely, does your employer have a retirement plan at work? And if they do, then you're subject to certain income restrictions that you have to be below in order to put money into an IRA. If they don't, if your employer doesn't have a retirement plan at work, then those income limitations don't apply, and so you can. And so it's obviously not too late to fund those types of accounts to hopefully reduce down your tax liability as much as it can be. Speaking of tax liability, some of the most egregious cases that we see in terms of people owing so much more than what was expected really do have to deal with the folks that are on Obamacare and wind up tripping over the income limit. So let's spend a few minutes just chatting about that, because the results on those situations have produced a pretty tough tax situation. So how Obamacare and the exchange works is that you apply, you get your insurance, and you put in various assumptions about what your income is going to be. And when you do that, then you get a lower premium, but that's a lower premium that at the end of the day is simply a prepayment of a tax credit, okay? It's not just, we wave a wand and poof, you get the lower premium payment on your health insurance. No. It's based upon the assumption that you qualify for a tax credit on that premium, and that tax credit is then paid as an offset or credited as an offset against the amount of health insurance premiums that you have to pay each and every month. So all of that is how that works. The problem is when you go and do your taxes and realize that, oh my goodness, I am above the limit. I'm above the threshold. And folks, that threshold, which kicks in right around, I think it's around 64,000, give or take, is a very hard threshold, meaning if you're $1 over, you're $1 over, and then all of that premium tax credit, the advance of that premium tax credit can very well be pulled back, and then lo and behold, you in fact now owe all of that in a lump sum. We saw a couple of returns this past year where that in fact happened, and their bills went from owing $500 or even getting a refund to owing $10,000, $12,000, $13,000. So big swings on it in terms of how that number plays. So if you're looking at your taxes and seeing that situation, which I think a lot of people, in fact, do see that because it's so hard to get an accurate estimate of what your income is going to be for next year, right? I mean, that's hard to do because you don't know. Maybe you've got some investment that pays a higher dividend. Maybe you get a little bit more on Social Security. All kinds of places where that can happen, and then all of a sudden you see yourself above that threshold. So just be aware of how that Obamacare stuff works, and the fact that that reduction in that premium isn't really a permanent reduction. It's a tax credit that's getting prepaid to you, and then when you do your tax return, that's where it all trues itself up. And so if you blow through the limit even by $1, then all of that's going to get recaptured and brought back in. And guess what? You then have to pay that as a lump sum on your tax return. So what can you do in that situation? Well, then you're culling back through the rest of the numbers on that tax return to see what you can do in order to bring down that income in order to get below that threshold. Now, remember, deductions like mortgage interest, charitable contributions, and the like won't help you do that because the tax credit that you get on Obamacare, on the health insurance, is in fact based upon income. It's not based upon taxable income. It's based upon adjusted gross income. So if you're in that situation, then you've got to look at ways in which to wind up getting an adjustment on your income. And one of the easiest ways to do that, which we did for 3 different folks this past year, is there was some level of earned income, some level of W-2 income. Even though they were retired, they were working a part-time job or whatever the case may be. And because of that, then we were able to do an IRA. And, of course, it's not too late to do that, although after tomorrow it will be. Then you were able to do an IRA and pull down that income to be below the threshold. And instead of owing $12,000, they wound up getting a $500 refund. So those are kind of how that could possibly play out. Another place to look at is if you happen to have a business or are self-employed, or maybe you have a rental property, is to carefully look at those expenses and just make sure you've got them all, and just see if you do, and if you don't, then perhaps if you add them back in, again, you may find yourself ultimately floating down below that income limit. So, but just be aware that for certainly enough folks that we've seen it on a somewhat regular basis this past tax season at the office, where you've got to know ways in which to pull down your income so that you're able to still retain your eligibility for the excess premium tax credit that was given with Obamacare. That can often be a huge surprise in terms of how that works. The reality is that you don't have a whole lot that you can do about that if you're over the limit, but there are a couple of tricks that you can do and still do up until tomorrow to be able to do that. And at the end of the day, yes, it is not too late to fund an IRA or an HSA, but certainly that's got to be done by tomorrow if you want the deduction for the year 2018. So hopefully the conversation about taxes and strategies that you can use was helpful to you all. We will be back next week, and we'll probably change it up from talking about taxes because at the end of the day, tax season will, in fact, be behind us. And I think next week is Easter, isn't it? Okay, so next week is Easter. So we'll have to do something special for the Easter Sunday program. So we've got a week to prepare for that. So we'll figure something out. Anyway, thank you all for listening to the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, here on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.